Rob, thanks. It's time to take a look at our business headlines. And for that, let's bring back in our new panel, the Executive Vice President for Commonwealth Foundation and Fellow at Independent Women's Forum, Jennifer Stefano, and Business and Market Analyst and Newsmax contributor, Seth Denson. Good morning, you guys. It's great to see you again.
Good morning to you.
So let's start off with the markets. Wall Street, we saw, ended a three-day slump yesterday, recovering Monday's losses. The Dow Jones adding more than 560 points on growing hopes that the Omicron variant can maybe be managed. Seth, I know we spoke about this roller coaster ride yesterday. Will the markets start to level off now, or are investors still taking it a day at a time? Are they still very cautious?
As the song says, one day at a time, one day at a time. I mean, listen, here's the reality of the markets. They're volatile because they're overvalued. We talked about that yesterday, Christina. And so, listen, if you're investing, there's two things here. Investing in the market or playing the market. Those are two different things, but most people should be investing in the market. If you're doing that, this is the new year. It's time to set your goals, look at companies with good balance sheets. I think the market is going to go through a correction in 2022. We're going to see interest rate hikes. That's going to bring the market into leveling out. So it's time to reassess and have a good game plan.
Awesome. I know that a lot of companies are trying to get people back into the office now. Businesses just scrambling, looking for workers. And not only that, but trying to boost morale with the workers that they do have. So now a lot of them are offering mandatory vacation days and blackout hours when meeting are banned. Jen, worker burnout is now a real concern and priority. I mean, these companies, they can't afford to lose any more workers. I know you're seeing the signs of help needed all across the city. Has the face of the American workforce changed for good?
Yeah, I think the American workforce has changed a lot. When we look at why there are such low participation rates right now in the economy, yes, it was the government incentivizing people not to work and to stay home. But what you're also seeing is that the baby boomer generation has decided to retire, to get out of the workforce, some of them early, and that they're not coming back in. And this is leaving a massive labor shortage. So we really have to start to grapple with the fact that you now have a large segment of the population deciding to get out of the marketplace when many of them are still able-bodied, still capable of working. You have a smaller workforce now having to support the Social Security in order to pay for that and the Medicare. And then you have just a smaller group of people trying to fill jobs as the economy seeks to get back on track. We really have to start to look at our immigration policy and how we can start to bring in and encourage workers back into the workforce, whether it be the baby boomers, whether it be through immigration, or whether it just be through increased participation among other generations.
Right. I mean, right, it's a very urgent dilemma. I don't want to see a lot of the places that I like to frequent go out of business just because they don't have workers. But one company that we're looking at is celebrating in time for breakfast this morning. Kellogg's finally striking a deal with the striking employees on the picket line for months. The unionized workers ratifying a new 5-year contract just yesterday. Now, Seth, is Kellogg sending a message to other big companies just to give workers what they want, or you'll lose them? And is that a dangerous message to send?
Well, listen, I think this is just like the market. It's all a trend. It's all about timing. I mean, this Kellogg's deal is just a third now in the string of deals we saw from originally John Deere, who had to give concessions, Kaiser Permanente. I think this is a sign of the times that companies whose CBAs are coming up, they're going to have to negotiate, and that's what's happening right now. That might change in the future, but it's certainly not right now. Kellogg's had seen their stock give up half of its gains this year, and I think they just looked at it and said, this is the time we need to do it. We are in a tight working market, and that's what we need to do. And companies just have to assess that for themselves. But as of right now, this certainly seems to be the trend.
Exactly. I mean, you're seeing it everywhere. I'm getting my master's right now at Columbia, and we see the student workers there, the graduate school workers striking right now, not wanting to be able to work. Luckily, they did strike a deal, so classes are able to kind of resume without disruptions. But we are also following a couple of important recalls right now. Fresh Express calling back branded and private label salad products due to possible listeria contamination throughout the Northeast, Midwest, and parts of Canada. And Procter Gamble recalling 32 aerosol spray hair care products in the U.S. after benzene was found. Seth, these are some serious problems. Can companies right now, with all their battling, afford to make stumbles like this?
Well, I think certain ones can. Procter Gamble, we talked about balance sheet at the top of the segment. Procter Gamble has a great balance sheet, and I think that they did the right thing. This was a voluntary recall. They got ahead of it. There's been no known cases here, and the stock market rewarded them effectively by leaving their stock unchanged. I mean, it's down just a hair yesterday. So I think the companies that can afford this are those with good balance sheet that get ahead of it. Those that don't and wait, those are the ones that are going to pay the price.
Jennifer Stefano, Seth Denson, thank you so much for coming on again this morning.
Hey, thanks so much.
For having me.